Good morning, everybody. We'll go ahead and begin. Thank you, everyone, for joining us for our webinar this morning on the issue of the day, which is Calpers Funding Risk Mitigation Policy, the history, current status, and outlook. I am your humble moderator for today's meeting. I'm David Takearts. I'm the Stakeholder Strategy Manager for Calpers. Before we dive into the material, and introductions of our presenters, just want to cover some quick housekeeping questions and set the stage for what you'll be seeing here today and how the format will work. Number one, yes, the slides will indeed be made available to all folks who registered. We will send that out after the meeting along with a survey to get your opinion on how things went. This webinar is being recorded, so just be mindful of that. And it will be made available, the full recording, including the Q&A session at the end, will be made available, and that will be posted to our ALM webpage on the public Calpers website. I'll be discussing how you can access that at the end, but that will be made available within just a couple of days. As far as questions will be asked, we're going to go ahead and ask you to enter all questions into the chat button of Zoom, as opposed to the Q&A function. Those two things look similar, sound similar, but they are different vectors for getting questions in, and things tend to get scrambled up, and one channel gets a little bit more attention than the other. So if you have any questions, please do type them in into our chat function. Because we have over 550 people on this Zoom, it's really not going to make sense to try to take verbal questions. That will just simply be chaos. And so we are asking you to please just type in all of your questions, and then I and my team will curate those and moderate them and verbally ask them on your behalf to the presenters at the end. Speaking of format, we are going to go ahead and run through the full presentation before we get to questions. We think that a lot of the questions that bubble up at the beginning will likely be answered by our presenters as we move through material in a sequential sense. And so we're going to ask for questions at the very end. Feel free to type them in as they pop into your mind as we go, but we won't be addressing those until the end. We do expect to have certainly at least 15 minutes of Q&A at the end, perhaps even more, depending on how quickly we cover the topics. And we'll make sure that we're going to answer as many questions as we can. Any questions that aren't addressed, we're going to capture. I just got to note that I'm on mute. Are people not hearing me? Michael, can you give me a thumbs up if you hear me? Okay, so whoever just typed that in, I'm afraid that you're the one with your speakers on mute, sir. So, okay, I'm getting some more messages that people can hear me. I had a moment of heart-stopping fear that I was speaking into the ether and nothing was happening, but looks like we're on track. So let's go ahead and continue. So again, our time today is 1 hour. I've gobbled up 3 minutes of it already, so let's go ahead and get into it, and I'll introduce our speakers and presenters and experts for today. So let's go ahead and move on here. We've got our main speakers are going to be Michael Cohen, who's our Chief Financial Officer. Michael is the tip of the spear on all things related to the risk mitigation policy and our broader, more expansive asset liability management work for Calpers, which many of you will be aware of as well. So we've got Michael Cohen. Then we're also joined by our Chief Actuary, Scott Tarando. Christine Reese is an investment director in our investment office, specializing in portfolio construction. And then there's my lovely mug as your moderator for today. Quickly looking at the agenda, this is the rough format that we'll be covering it in order. We're going to take a look at the history and purpose of the risk mitigation policy. We're going to examine what are the conditions for triggering that policy. What has to happen in the world in order for risk mitigation policy to be activated and go into effect. We'll then talk about the timing and sequence for implementing the policy. And number 4, particularly important, what's its context within the broader asset liability management process that's going on right now at Calpers. We'll then zoom in and look at the impacts on both employer and employee contribution rates. And lastly, we'll examine ways where you as stakeholders, whether you represent the employer community, whether you work for an employer, whether you're schools, a public agency, the state, or if you represent members, if you represent employees of those employers who are members of the Calpers system, or retirees who are drawing pensions right now. Everybody has some skin in the game on this, and we'll outline ways and what's the chronology for the board looking at these important questions coming up over the next few months. So without further ado, let me go ahead and turn this over to Michael Cohen, our CFO, to walk you through the history of the policy. Go ahead, Michael.
Thanks, David, and good morning, everybody. It's a pleasure to be able to speak to you virtually today. So here we are on slide 4, and we've actually have not really defined what the risk mitigation policy is. So just in very short terms, and we'll get into much more detail as we go, but basically this is a policy adopted by the Calpers board in 2015 that gradually lowers the system discount rate in good financial years where we've had excellent financial returns. And so that's really the history and the purpose. But since 2015, we have not actually triggered that policy. The reason for that is when we lowered the discount rate from 7.5% to 7% back in 2017, this policy was suspended, so there wasn't an overlap of discount rate reductions on discount rate reductions. And so, but the policy is currently active today as we have fully implemented the 7%. And based on what we know through the third quarter of returns, which we've publicly announced were 15%, and since then, returns have continued to be very solid, we would suspect, barring catastrophic event over the last week of the month, that this policy will be in effect for this year and will get triggered. So really, to get more into the purpose of the policy, you see the next slide here that has a number of boxes with a number of terms. And the reason there's not a precise purpose is I think it really did reflect the board's thinking at the time that there were a lot of different concepts going on, some of which are sort of pull and push kind of concepts. There's a lot of trade-offs in them, but ultimately our board, as they always are, was concerned about the long-term sustainability of the fund. There was concern in particular that our investment strategy was going to yield very volatile returns that over time might not hit the target discount rate. And so ultimately, we ended up with this funding risk mitigation policy, which, to be frank, is a confusing title because it really depends on where you sit as a stakeholder, whose risk we're mitigating. But ultimately, I think I would say that the purpose of the policy is to slowly lower the discount rate to ensure the long-term sustainability of the fund using the good financial years, those fiscal years where we've had above targeted returns, to slowly lower the discount rate over time. So with that, why don't we go to the next slide and get more into the details on how this works. So reading left to right, you sort of get a sense of things. And really this policy only comes into effect where we have a year of investment returns that exceeds our discount rate by at least 2 percentage points. So given that our discount rate is currently 7%, you're talking about years in which our investment returns exceed at least 9%. If you have one of those years, then the policy does go into effect, and we basically have an incremental reduction in the discount rate. So, and what happens there is you have the lower discount rate, and as all things, as we've been talking about, as David mentioned, the Asset Liability Management Study, when we lower the discount rate, you have an increase in known costs. And so that's what we call the normal cost of the system on an annual basis. So those known normal costs go up, but the theory being that you're able to adjust your investment strategy so you're more likely to hit the actual discount rate, yielding less unfunded liability, which is the most expensive type of liability that the system can have, because you as employers are going to be paying 7% interest on that unfunded liability. So there you see we basically are lessening the impact of possible future market downturns because of a lower discount rate, you're more likely to hit that rate over time. So just going one step further on the next slide to really give you a breakdown of how this policy works is there's various steps along the way that the better the returns are, the more the discount rate gets lowered. So to read this chart, as I mentioned, the policy doesn't have any effect if you're less than 9%. So at that 9% return, you lower the discount rate by 5 basis points from 7 to 6.95 in today's environment. And then that is the case anywhere between 9 and 14% returns. And then when you hit 14% returns, you enter a new step. And so rather than a 0.05% reduction in the discount rate, you step up to a 10 basis point reduction, so 6.9%. So as I mentioned, at the end of the third quarter of the fiscal year, we're at 15%, which falls squarely between the 14 and the 17% link items listed here. So under that scenario, if the fiscal year had ended at the end of the third quarter, we would have been at the 6.9% because 15 is between 14 and 17. And ultimately, this policy was really structured so that obviously it depends where you fall within a particular range. But the notion is that we were sort of sharing both. In a normal year, you would have, if your returns exceed 7%, that yields a rate reduction for employers. So in good years, we're basically under this policy sharing that typical rate reduction between the reduction to employers and a reduction to the discount rate. So then the next slide really gets into what was one of the key questions we got at a previous asset liability management webinar. And I assume most of you who are watching have been also watching those webinars, but if you haven't, they're all archived on our homepage, on the ALM dedicated page that David will talk more about in a bit, but you can go back and rewatch them. But really the question was, well, how does this policy interact with the asset liability management process that we're going through, and we go through every 4 years. So this is a sort of a routine process we go through that basically is an effort to make sure we're using the most up-to-date information, the most up-to-date data, and we analyze what the likelihood of our ability to meet whatever the discount rate happens to be. And so in this year, we're not blind to the fact that the risk mitigation policies is operating in a year that the ALM is also occurring. And so really what will happen is that whatever the risk mitigation policy yields in a new discount rate, that will become the new baseline for our board to consider a new asset allocation and a new discount rate through the rest of the process, which will run at least through the rest of this calendar year. So by the time our board is ready to make a final decision on the ALM process, they will be fully aware of what the risk mitigation policy yielded and can make adjustments accordingly. And so that's really what you'll see the rest of this year. That on the next slide, as I hand it over to Scott Tarando, he'll walk through the implementation timeline and give you a sense of really how the dates interact with the risk mitigation policy and the ALM process. So let me, with that, turn it over to Scott.
Thank you, Michael, and welcome everyone. One of the questions that always comes up is the timeline. When does this occur? When does the ALM occur? And also I think more importantly for the employers is, when will this impact my rate? So we have kind of a graphic up here that I think explains it fairly well. You know, on the top blue box, you can see the risk mitigation policy. Our returns for fiscal year will be locked in next week on June 30th, and we'll be announcing what those rates of return are in mid-July. Now, on the bottom part, you can see also happening in July, we're going to be having a conversation at the board offsite about the current capital market assumptions, and that will obviously lead into have a major impact on the ALM process, asset allocation, and ultimately the discount rate that gets chosen. So you can see there's overlap between these two policies and functions. Keep in mind is both of these impacts will be kind of rolled up and be reflected in the 6/30/2021 valuations. And then what you see are the next two blocks. For state and the school employers, the 21 valuation impacts the 22-23 fiscal year contributions. So those will be reflected during that fiscal year. For public agencies, there's an additional 1-year delay. And that's basically just due to processing time and us getting the valuations out in a timely manner. And so agencies have some time to look at it. So you can see anything related to the ALM this year and the risk mitigation policy will be reflected in rates for schools and state employers in the 22-23 fiscal year, and for public agencies, the 23-24 fiscal year. Next slide, David. All right, thanks. So, what happens and how does this kind of work? So, if let's assume we have a 15% return, and that's comparable to what the return was for Calpers through the last quarter, I think March 31st. The discount rate would be reduced around 10 basis points, which gives us a 6.9%. Now, given that we're right in the middle of that ALM process, we wouldn't immediately make changes to the asset allocation. We're going to incorporate the results of the both what's happening with the ALM and the risk mitigation policy, and have one final portfolio going forward. For classic members, the contribution rates generally don't increase. For most members, classic members, they're locked in. For Pepper members, there'd be potential rate increases. It varies from employer to employer on where you are. But generally, you would anticipate around a 0.5% increase for a number of members, and averaging out for Pepper members. For retirees, obviously, there's no change. So then, thinking onto impacts for an employer, we have a sample city here, miscellaneous plan, and we have, I think, 3 different lines. The top line, the black line, is our base case, 7% return, expected 7% return with 7% discount rate. And you can see how the costs go up a little bit over the next few years and then work their way down. The 2 lines below it, the blue line would be if we got a 15% return and we didn't have a change to the discount rate. And the orange line in between the 2 is what happens when we drop the discount rate 10 basis points. So what you can see is even though the discount rate drop did occur, rates still decrease for the employer. You can see that both lines are well below the original black line. You can see the cost. The orange line basically is about halfway through for the most of the part. And I would like to point out in the first several years, the first 3 to 4 years, both the blue line and the orange line are very close to one another. So there would be the difference in contribution levels are very close to one another, whether we drop the discount rate or not in the first several years. Keep in mind, some of the benefits we're getting out of this is the rates are still coming down for the employer, but we're kind of reducing the volatility on the asset side. So rates become a little bit more stable. And that's kind of like the trade-off that's going on here. On the next slide, we have a similar situation here just for a safety plan. Rates are more elevated because it's a safety plan, but we have basically the same typical results where you see an overall trend of the rates going down in any of the situations. The orange line kind of going right in between the blue line and the black line, kind of like midway. Again, making a balance between contributions still coming down, but not quite as much as if we didn't drop the discount rate. But we get, on the plus side, some reduction on the volatility.
Pardon the interruption, Scott. This is David. Just a question that came in to me. I want to make sure that I think is worth asking here. A question came in. Do these charts for these two, the plans for the sample city, are these reflecting a continued 15% return or an assumed 6.9% return after this one kind of like really good year? Can you just clarify that?
Yeah, so the top line, the black line, it's a 7% return, 7% discount rate for the whole line. For the other lines, it's a 15% return in the first year. And then for the blue line, a 7% return thereafter. For the orange line, it's a 15% return in the first year and a 6.9% thereafter. So basically, there we have the initial first year that reflects the higher return, and then there's no gain or losses on the investment return for the remaining years. So it's a 7% on the black line and the blue line, and a 6.9% return on the orange line.
Thank you, Scott.
Sure. And then at this point, I'll pass it back to David, who'll kind of go over and give you guys an overview of the whole schedule for the remaining year.
Thanks very much, Scott. So as you've heard here, one of the main takeaways is that the risk mitigation policy and that likely imminent triggering of the policy and the subsequent reduction of the discount rate is really being folded into this broader ALM process, the Asset Liability Management Process, which includes several sort of milestone occurrences wherein we are looking at what are the most probabilistic outcomes in terms of capital market assumptions and the experience results, meaning the demographic and economic assumptions around lived experience of employees that result in costs on the sort of like the liability side of the equation. So what you're seeing here is our ongoing timeline of major things that are being brought to the board. Just want to remind everyone that it's really not Calpers professional staff that ultimately makes the decisions. It's really the Calpers board, and those meetings are all public, even in the virtual environment that we've been in for so long. We are looking, by the way, to start transitioning back into live in-person meetings starting in the fall. But for now, they are virtual. And we always encourage everybody, all stakeholders, to participate and watch those. We understand that giving up 2 to 3 days of your time can be very challenging. However, these are truly consequential board meetings that are coming up here over the next few months. So I would encourage you, whether yourselves or if you can designate one of your advocates or representatives, to keep their finger on the pulse of what's going on and also participate in terms of engagement. These are public meetings. We encourage public testimony. If you want to send in letters expressing your organization's position on any of these, we certainly welcome that, and we will get them in front of the right eyes to make sure that those are considered as we go forward. So some of the big things to look at, I mentioned in July, this is the board's, I'll put up some air quotes, offsite. It's all virtual still, but traditionally the board would go to a Sacramento location for these meetings. For our offsite, it'll just be on a different background of Zoom. They're going to be looking at those capital market assumptions, which is the expectations for what the long-term returns from the financial markets are most likely to be. Again, not an exact science, but this will sort of set the expectation for where those returns would be. Obviously very important in terms of how we calibrate the fund. So there will be multiple educational sessions for the board, helping them to understand the process and framework, bringing in experts from both within and outside Calpers professional investment office to give the best possible prognostications on what they see coming in between the next 10 and really 30, 40 years to help us set our expectations. So that's very important. Then in September, we'll be looking at some possible situations and scenarios in terms of asset allocations and the attendant discount rates that would emanate from that. Again, Depending on how the risk mitigation policy triggers, that will sort of set basically a floor for that. And so we'll be building off of that. And then we'll also be looking at that draft experience study from Scott Tarando's actuarial team, where we'll be looking at what are the expectations for inflation, for life expectancy, for salaries, for disability retirements. What are all the things that go into that basket of the calculation for what the cost for pensions will be going forward? Then moving into the end of the year, that's where we'll have those final results. We'll really be kind of dialing in the focus of the conversation with the board on potential candidate portfolios, looking to adopt new actuarial assumptions, potentially approving the discount rate right then and there as well. That process may extend out a little bit, just kind of depending on the board's level of comfort with making the decisions at that time. So again, these meetings are all going to be publicly broadcast or in person, and encourage your participation in that. In addition, at the bottom of this slide, you can see that we're in the midst of holding a series of quarterly webinars just to keep stakeholders like you informed. Again, we know that it's not easy for you to, you all have full-time jobs and it's hard to follow along with these public meetings. We get it. And so we have these webinars. We've done 2 so far. The next one's coming up August 3rd, where we'll be briefing everyone on what has been decided, what's currently on the docket, and what's coming up in the future in terms of this asset liability management process. So really just trying to get the information out there to stakeholders early and often, helping you understand what's going on. And then we'll do another one in September. So all of you, the folks who were invited to this webinar would of course be invited to that. And as Michael mentioned, we do have all of this stuff is being archived on the Calpers website. That's calpers.ca.gov. The easiest way to find it is just go into our search bar and type in ALM or Asset Liability Management. It'll take you to a centralized page where we've got recordings of all of the public meetings, all of the webinars that we've done. If you missed those ones in January or April, this webinar will be archived on there. We've got frequently asked questions. We've got all of our actual official policies on there. So lots of ways to stay engaged on this for stakeholders who want to be a part of the ongoing conversation. Okay, so with that, let's go ahead and move into the question and answer phase of this. I know that they've been pouring in as I've been finalizing the work there. So go ahead and type in your questions. Again, please use the chat option. There's a Q&A one that looks similar, just for the ease of us seeing everything, if you could go with the chat one. The first one I want to ask, it could be to either Michael or Scott. The question was, is there a floor to how low the discount rate could be lowered depending on our investment returns? So I believe on an earlier slide, I'll just go ahead and back up to it here. One of our early slides here with here's the tiers or the step downs. What if we were to return 29%? What would happen to the discount rate there?
Sure. So let me take that one. So in any particular year, there is a maximum reduction, which you see here, which is 25 basis points. If the question was more about a floor from successive really good years, the policy does not have a floor on that. So you could have, theoretically, if we hit 24% year after year, you would go 25 basis points, 25 basis points, 25 basis points. That being said, the policy does ask us to review this risk mitigation policy every 4 years in conjunction with the ALM policy. So as well as our board reviews the ALM on a mid-cycle review after about 2 years. And so there are regular check-ins where we're comparing what we're seeing in the market with what our current discount rate is. So the policy itself has no floor in terms of how low the discount rate would go over time, but there are regular check-ins that would allow the board to basically manage how things are going.
Thank you, Michael. And just to be clear, if we were to get a 30% this year, it would not drop the discount rate lower than 6.75 in that 1 year.
In that 1 year, that is correct. Okay,
very good. There's another question that's along the same line, so perhaps you can just continue with this thread and then we'll move on. Will the change in the discount rate be locked in until the next future event, or will it slowly return to 7% after a period of time? Is there Basically, is there a time limit on this discount rate reduction that will expire at some point?
No, once the rate changes, it's changed, and that becomes the new base going forward. So, but the answer is sort of the same in that our board sort of controls what the ultimate discount rate is based on Scott's calculations and inputs. So there are regular check-ins, but once a discount rate reduction is triggered, that becomes the new discount rate. It's not, there's no sort of, oh, this is in effect for 5 years or 10 years. It is the system's discount rate going forward until another event changes.
Thank you very much. This one's probably more for Scott, our chief actuary. Why would some PEPRA plans have an increase of 0.5%? Can you just give a little bit more context around that? What would have to happen for that to occur?
Yeah, so when part of PEPRA was introduced, as you're well aware, there's a normal cost sharing, so employees need to pay half the normal cost. But part of the law stipulates that, you know, once the normal, once employees' contribution is set, they stay at that level until there's more than a 1% increase in the normal cost. So basically, it's like you can think about it. It doesn't change every time there's an increase or a decrease in the normal cost for the employer. Basically, you need a full % increase from the last time the normal cost was changed to trigger a PEPRA contribution increase for employees. Because we have that 1%, you take half of that, you're looking at least a 0.5% increase for employees. So this was set up so employee contributions didn't change every single year. So, you know, it adds a little bit of stability on the employee side. The downside is it's sticky. So then when there is a change, it's going to be a bigger amount because, you know, you've had this increase kind of build up over several years. And now even a very small change can trigger, you know, what appears to be a 0.5% increase or possibly even more. So.
Hey, Scott, and a related question in terms of like timing of when that might be likely to happen given these scenarios. So here we are. I'm just going to go to this slide again. This one was focused really on the employer budget impacts. Back to that PEPRA issue, assuming that we do trigger the policy this very year and the discount rate reduces and the PEPRA threshold were sort of like hit, when could employers, or really let's just focus on employees, when would employees expect to see, PEPRA employees expect to see that increase in contributions coming out of their paychecks?
The same years that are up on the screen here for the employers. So the PEPRA rates would go up the same year that employer rates would be affected. So 22, 23 for the state and schools, and 23, 24 for public agencies.
Very good, thank you.
Sure.
This one probably sticking with Scott here for a moment. So if the discount rate is lowered, what effect is made on the UAL specifically? Can you just, I know it's going to be difficult to come up with firm numbers, but you know, these charts that we showed are really more, you know, this is the combined overall rate, which is the normal cost in the UAL. Can you just speak in general, you know, discount rate lowers, what happens to UAL?
So basically when you think about the discount rate, you're taking your expected value, present value of benefits, and you're discounting that at you know, or the discount rate. And what happens is as you lower your discount rate, the value of those benefits in the future become more expensive or becomes a larger number. So when you lower the discount rate, you're going to get a larger liability number and you're going to get a larger normal cost number. And for your unfunded liability, you know, your liabilities are going up, your assets aren't changing, it stays the same. So your unfunded liability is going to be also going up as well. So when you just in isolation, when you drop the discount rate, your unfunded, your liability goes up, your unfunded liability goes up, your normal cost goes up, and your funded status goes down.
Very good, thank you. I had a question on whether or not, this one's more to me, to be honest. the question was, is the July offsite going to be open and available to the public? The answer is yes. Those always are. They're just not always super easy to just geographically access because it's not in our normal Sacramento office. It'll be somewhere nearby. However, since it's in a virtual environment, the answer is yes. The public is certainly welcome to that. And there's just a broader question. What are the exact dates and times for all the board meetings? I'm going to ask one of my team members to post a link to the board page from the Calpers website. Always the easiest way to track down the dates for upcoming board meetings. Generally, they're the third week of the month, and they run Monday, Tuesday, and Wednesday. The exact times of the committees, though, and those of you who work in the local government world know that the exact time for any particular committee or agenda item within the committee is always subject to fluctuation due to how long the previous items went and questions and public comment and whatnot. So it's very difficult to pin down, okay, please log in at exactly 11 o'clock for XYZ discussion. It's really a little bit more fluid than that, as you probably can guess. So, but the times of the committees are available, and I'm going to ask a team member to post that in the chat for everybody. So here's a question that came in, and this one might be a kind of a combination of Michael and Scott. So, so pointing out that there seems to be a little bit of a counterintuitive piece here. Returns exceed assumed amount, resulting in additional profits. Okay, so high excess returns. Yet this then lowers the return assumption, which increases the employer's contribution. Where do these excess profits go?
Sure, and I think this gets back to the core of this policy, and it is a little confusing, which is why we're doing this webinar, because we wanted to give everyone the opportunity to understand it to the best extent possible before it gets triggered for the first time. So I think the key is, again, the underlying assumption that our board made several years ago that long-term it was best for the fund and expected that the discount rate was going to be coming down. So really it was a question of, do you want that to happen gradually? Do you want it to happen all at once? And ultimately they landed on, we want it gradual in the good years so that any effect on rates is not going to be severe, and where you're potentially lowering the discount rate on top of a bad year that would tend to get your rates going up already, and then a lowering of the discount rate gets your rates up slightly more again. So that's sort of the fundamental thinking behind this policy. But ultimately, and I'll turn it over to Scott to go into more detail, but ultimately every dollar earned by the fund is not going anywhere. It's either going to go to lowering returns or lowering rates paid by employers or lowering the discount rate. And both of those things it all works together in terms of the actuarial soundness of the fund. But let me stop there and let Scott do a better explanation of that.
No, I think you covered most of the points, Michael. And I think a lot of people are the question was kind of like, where did the profits go? It goes back to when we drop the discount rate, there's an increase in liability, and so if you think about it, if you get the 15% return, that would normally decrease your unfunded liability, but we're dropping the discount rate, which is bringing the liability back up. So part of that investment gain is paying off that increase in liability that's occurring due to the discount rate drop. Hopefully that makes sense. And that's kind of why when you look at these charts in terms of you see with the risk mitigation policy, it's you end up halfway in between the two. It's basically you're using some of the investment gain to pay for that increase in liabilities when we drop the discount rate.
Thank you, Scott. So there was a number of questions along those lines, folks. So hopefully that addressed that. If not, please go ahead and enter a follow-up question in the chat for us to see. Yeah, that was tying together several folks a little bit there. There's also some questions back to you, Scott, more the technical. When will we see this in either our valuations or our budgets line? I'm going to move the slide deck right back here to this slide here. On again, this is not showing numbers and dollar amounts. It's more about when would we as employers see this? Scott, can you just walk us through again? What would be the time when they would see the actuarial valuations? If you can distinguish between the title of the valuation and the actual real-time date when folks would expect to be getting those, and then when do the costs really hit budgets?
Okay, so sure. So I'll just basically talk primarily about public agencies. So if you think about right now, we are working on the 6/30/2020 valuations, and those normally come out in August or September. And then that will affect, it's 2021, so that will affect the 2022 rate. So basically you get a lead time of around 10 months or so. Just basically move that whole schedule forward. We would, any change in discount rate and any additional changes that we make in due to the experience study and changes in demographic assumptions, they'll be reflected in the 6/30/2021 valuation. Those valuations come out, let's call it fall or late summer, early fall of 2022, a year from now. The earliest the fiscal year your rates would be effective is the next fiscal year, which starts in 2023. So basically, if you want to just simplify it, any changes that occurred right now, you'll see in the 23-24 contributions for fiscal year.
Very good, thank you. And so as a layman here, as a non-actuary, I call this the 1-1-1-1 process. So if you're looking at the 2021 valuation, you actually got that in the real year of 2022, and it's impacting the 2023-24 real life budget. So it kind of goes on a 1-1-1 year cadence. So not intuitive for a lot of folks who aren't actuaries. It's taken me and I talk about this stuff 24 hours a day for my job for 7 years, and it's taken me a while to get it. So that's the general flow there. And again, that's just for public agencies. If you work for a school or a state employer, there's less of a lag there. It actually shoves forward 1 year. So thanks for that, Scott. A question here was, let's say that the risk mitigation policy is triggered. Would the reduction of that discount rate and the reduction and the change in costs be phased in over multiple years the way that it was with the big ALM reduction from 7.5 to 7 4 years ago?
I'll take that one. There's no anticipation of phase in. The phase in was kind of set up to deal with a large increase in employer contributions. And when you think about it, the costs are mitigated by there's minimal impact to the employers. If you look at the contributions, your contributions are still going down on the graphs in terms of both the safety and the miscellaneous. There's no need to phase it in because basically the increase in the liability has been covered by the gain on the investment side. So there's nothing really to phase in. That's basically it's already been paid for. And so you'll have a slight increase on the normal cost, but you'll still have probably excess earnings being amortized over 20 years to help cover the normal cost increase as well.
Very good, thank you. Okay, I just got 3 questions that came in and they said virtually the same thing. So I'm going to try to summarize it. And I think this is probably to you first, Michael, and with Scott kind of finishing up. So the general gist here is at the end of the day, with the drop in the discount rate from the policy, raising the employer rates, but then the excess returns of 15%, lowering the discount rate, what is the net effect going to be for employers there? Like, what if you can just walk us through it again? Like, we have kind of like an upward impetus and a downward impetus interacting at the same time. What can we expect the net effect to be for employers?
Sure. I think the answer to that ultimately is going to depend on the specific increase of investment returns we have, because depending on where a return falls in that band, you're going to have a slightly different effect. But I can speak to the general philosophy behind the policy was to share evenly or roughly evenly the value of the over expected returns between lowering the discount rate and lowering employer contribution rates. So it's really going to depend on an employer specific circumstance and where in a particular band you fall. But the net effect is going to be, probably a mix of both, that you've got, some lowering of your contribution rates and some compared to where they otherwise would have been. And that, of course, is always important, that we, these charts are sort of, the black line is showing the projection of what we were expecting actuarially. So sort of what you could have planned on. So this is all comparing to what you were planning on and lowering those combined with a lowering of the discount rate. Scott, you want to add anything to that?
No, I think you caught it. The key aspect is where do you fall in your range compared to the hurdle point for each drop in the policy, and if you just get over it, I think the policy was generally set up so even if you hit a hurdle point, there should rates should come down somewhat, no matter what. I think that was the goal. Obviously, as that was set up several years ago, and we'll see how things play out. But I think the key point is, as Michael mentioned, where do you fall in that range? Do you fall just above it, or are you a little bit higher above it? That there's more investment gains available to lower the rates.
Thank you. Okay, this question is for Christine Reese, who is in our investment office, again, looking at portfolio, like the investment portfolio construction as it relates to these types of changes that we're talking about. So Christine, can you just talk to us about what would happen to the asset allocation with this discount rate reduction? And we've talked a lot about the timing of it, but so kind of setting aside when, can you talk to us more about the what and how in terms of changes to the investment portfolio based on the risk mitigation policy and probably ultimately the ALM policy changing our future expectations going forward?
Yeah, thank you for the question. Just confirming you can hear me.
Yes.
Okay, great. So, the markets are always changing. And if all things remained equal and we were reducing the discount rate, then we would look to potentially modify the asset allocation to reduce risk in the portfolio. But as we know, markets are always changing, and we're in an environment now where from 4 years ago, we're looking at lower returns and higher risk profiles out in the marketplace. So as mentioned earlier, with the reduction, the potential reduction from 7 to 6.9 in the example, that would be our starting point in terms of looking at the asset allocation. We would go through all of our analysis and evaluation to come up with, the asset allocation. And one important step is really talking about, a risk tolerance, risk budget. And we're right in the middle of that process, so we don't yet know kind of where that's going to fall out. But we typically do align the forward-looking future return expectations with the discount rate.
Thanks, Christine.
Michael, yeah, sure. I wasn't sure if Michael wanted to add anything on to that.
No, I think you got it, Christine. Thank you.
Okay, thanks.
Michael, this one's for you. So at least two questions are along the lines, along these lines. Assuming that the risk mitigation policy does trigger, and we're assuming 15% return, which would drop it to 6.9, is there a likelihood / possibility that the ALM process could further reduce the discount rate?
That is certainly a possibility. And as Christine just said, we're still going through the analysis. But as I mentioned in a previous webinar, certainly the long-term trend has been for these expectations, the capital market assumptions going forward to keep coming down. And so that is certainly a possibility. That was sort of what the board expected when they adopted this policy in 2015, that the long-term trend was going to come down, and whether or not whatever the reduction happens under this risk mitigation policy is enough to capture that long-term trend. It's hard to know since we don't know what the returns are and we haven't done the full analysis, but it's certainly a possibility that the board will come in based on the data they have and revisit, did the policy go far enough? And on the same question, they will be asking, well, did the policy go too far? But certainly the long-term trend is sort of downwards as opposed to upwards. So, but everything will be in front of the board to make those calculations and determinations.
Thank you. This one is back to Christine, more on the investment side. So there was a question for someone who was looking to find the sort of like day-by-day investment returns for Calpers in terms of investment performance. So I'll take the first part of that question. Those are not posted on the website on a daily or even monthly basis. They are updated in our board meetings, and there's a couple of reasons for that. I'll give the overarching reason, and then I'll pitch it to Christine for some of the more particulars. So the main reason is that Calpers is a long-term horizon investor, and we think it would not be prudent to be attempting to post, okay, here's the daily investment performance of the fund, given that really what matters is the very long term, and we're speaking in decades here. But even on a yearly basis, it can fluctuate very quickly. And what's important to us is really not the returns on any given date, it's the returns on June 30th. The fiscal year is really what matters. And so we don't want to, incite isn't maybe the right word, but provide fodder for folks taking directions and assuming long-term results based on daily fluctuations in the market. So that's why we don't post it regularly. But I think there's also more practical concerns about valuing some of our investment returns on a very easy basis, like private equity and real estate. So Christine, if you could just add your comments on that, on why it's difficult to track on a daily basis exactly what the returns are for Calpers.
Yeah, well, I think you've done a great job actually answering the question, David. But on a valuation basis in private assets, so private equity and real assets, those valuations, the returns are lagged a quarter, and so in any given quarter, we're still compiling the information from the private equity firms and the assessors for the real assets to calculate that return. So in terms of posting kind of intra-quarter, we don't provide that because we just don't have all of the information that would need to provide an accurate daily return. So what we do post are we post our quarterly returns so we just posted, for example, at the June board meeting, we posted the March quarterly returns, and that would show the fiscal year to date returns. So like I said, you handled that question really well. I don't know if I have additional information to add there.
Great, well, thank you. I just echo what I've heard you say in the past, so apologies. So here's a question probably more to Scott Tarando, our chief actuary. Can we use the pension outlook tool to see the impact of the discount rate change and the high investment return? And maybe Scott, if you could remind folks what pension outlook is, where they can find it, and then address the question of can we model this out right now?
Yeah, thanks, David. So Yes, you can model these things on Pension Outlook. I wouldn't be surprised if we use Pension Outlook to give you some of these charts here. Basically, Pension Outlook's a tool that's available to employers. It's on the web. There's no charge. You go in and it allows you to run different investment returns, change the discount rate, and see the impact on your particular plan. So for this case, what you'd want to do is you want to go in and you'd want to put in like 15% return in the first year. I think you'd want to, in this example, we've said it. So you change the discount rate to say 6.9. You put the first year return to 17 or 15%, and the remaining years to 6.9%. And you got your one line here, and it'll show you before and after. So yes, employers can go and generate what these impacts would be on their particular plan as well. And Pension Outlook basically gives you the ability to change a discount rate, change in expected investment returns, and as well as making additional, if you guys want to look at impacts on additional payments, you can put those things in as well. So you can just see the impact on your particular plan. David, you're muted.
There we go. Sorry about that. So quick technical question for Scott. At the chart that we're looking at here on the screen, what is it on the y-axis, the percentage points? What does that represent?
Contribution rates as a percent of pay.
As a percentage of payroll. Great, thank you.
And I know that the amortization payments are dollar-based, but it's kind of hard to convey that on a single graph. So what we did is we took the dollar payments and we divided it by payroll to give you a percent of pay.
Thank you very much. This one's back to Michael Cohen, and folks, we've just got 3 minutes left here. So I am going to try to do a bunch of them real quick. So Michael Cohen, does the risk mitigation policy work in reverse? Meaning if we were to get a 3% return, does the discount rate automatically lever up?
No, it's a one-way policy. As I mentioned, it's designed for in good years to soften the blow of an expected reduction in discount rate over time. And I've seen a couple questions on why that's happening. It's really tied to the long-term trend of risk-free investing going down. So as interest rates have come down, we have to take more risk to get a similar result. And so because of that long-term trend expected, that's why the board has expected the discount rate to come down over the long term.
Thank you. Scott, how would the risk mitigation policy impact fully funded plans?
Really no differently. You think about it, you have an investment gain. You're getting, whether you're 100% funded or 50% funded, you're going to get the gain on the assets that you have sitting at Calpers, and your increase in liability is going to be the same regardless of your funded status. What happens is as you get more fully funded, small changes, it adds very volatility to what you're making in terms of contribution, because if your baseline is 0, any slight change is going to be reflective of it's going to look like it's possibly a large percentage increase. It could be a smaller dollar amount increase, but as a percentage, you get a little bit more volatility as you get fully funded. But in terms of whether this doesn't impact whether you're 100% funded or 50% funded any less or better in terms of the impact on your liabilities are the same. If you want to think about it, if you're fully funded, you had more assets in the system and you got a 15% return on more assets than if you were 50% funded. You can look at it from that perspective of gains are just everything. The returns on the investment side are magnified as you become more fully funded.
Thanks, Scott. This one's more for Christine on the investment side. So why is there a general downward trend of the discount rate? Is this because there's an expected long-term lower return? And I think probably the context here is that we're talking about a 15% return this year. Why is there a general downward trend?
Yeah, this kind of goes to a bit what Michael was talking about. There's a general longer term trend for the interest rates coming down. So the treasury yields or the forward-looking treasury yields are much lower now than they were years ago, and so the premium that an investor will get, say on stocks, the premium might be the same, but the overall return is much lower because the risk-free rate is lower, and that's so forward-looking returns are lower, which lead to we would need to have a lower discount rate to be consistent.
Thank you. I appreciate that. All right, all. We have reached the end of the hour, slightly breached it, in fact. So I want to thank all of you for your participation in this really robust conversation there. Hopefully we addressed the lion's share of your questions. I do see that there's a couple that we didn't quite get to, and our team is going to capture those and respond to you specifically. And so we'll get that back out. Again, this was recorded. We are going to get that all polished up and both posted to our website, and we'll also distribute it in our follow-up to all of you who registered to this. Want to thank our presenters for sharing information on this policy. So thank you, Michael, Scott, and Christine. Really appreciate it. Again, if you have any follow-up questions as you mold this information, stakeholders, go ahead and shoot an email to my team. I should have put the email up here, but it's CalPers_stakeholder_relations at calpers.ca.gov. So a little bit of a mouthful there, but CalPers_stakeholder_relations at calpers.ca.gov. Thank you, Josh. That's a lot better than what I just did. And go ahead and shoot us your questions, and we can be in touch. Again, lots of engagement opportunities for you, both at the board meeting and through upcoming webinars. And we'll look forward to sharing information and hearing from you. Thank you, everyone, and have a great day. So long.